The real estate market is one of the biggest drivers of the global economy. It affects everything, from the value of our homes to the stability of banks, and even the health of the overall financial system. But with rising interest rates, higher home prices, and economic uncertainty, many people are asking the big question, is a real estate market crash coming? Today, let's break this down step by step so you can understand the risks, the facts, and what this could mean for you as a homeowner, investor, or first-time buyer. First, let's talk about why people fear a crash. When housing prices climb rapidly, as we've seen in recent years, it reminds many people of 2008 when the U.S. housing bubble burst and triggered a global financial crisis. High mortgage debt, risky lending, and overpriced homes all created the perfect storm back then. So naturally, when we see home prices at record highs today, combined with higher borrowing costs, it raises red flags for many. Now let's look at the current situation. Home prices have surged over the past few years, largely because of low interest rates during the pandemic, supply shortages in the housing market, and strong demand from both buyers and institutional investors. But things have shifted. Central banks have raised interest rates aggressively to fight inflation, and higher rates mean higher mortgage payments. That makes it harder for new buyers to afford homes, which could cool down demand. But does cooling demand equal a crash? Not necessarily. Unlike 2008, banks today are generally more cautious with lending. Borrowers are stronger, credit standards are tighter, and there isn't the same level of subprime lending that led to massive defaults back then. Also, housing supply is still limited in many regions. There just aren't enough homes available to meet demand. That scarcity can help keep prices from falling too sharply. However, there are warning signs we need to watch. In some overheated markets, where prices grew much faster than incomes, we're already seeing price corrections. Investors who bought properties hoping to flip them for quick profits may be at risk if demand slows down further. Rising unemployment or a recession could also put pressure on the housing market, as struggling homeowners may be forced to sell, adding more supply and pushing prices down. So what does this mean for you? If you're a homeowner, don't panic. Even if prices dip, real estate is typically a long-term investment. Values may fluctuate in the short term, but over decades, housing has generally trended upward. If you're an investor, focus on fundamentals. Cash flow, rental demand, and location matter more than speculation. And if you're a first-time buyer, this could actually be an opportunity. A cooling market might give you more negotiating power and reduce the pressure of bidding wars. In conclusion, while the real estate market may be entering a period of slowdown, calling it a full-blown crash may be an exaggeration for now. The market is certainly facing challenges, but it's also more resilient than in past crises. The key is to stay informed, avoid panic decisions, and focus on long-term financial stability. So, will there be a real estate crash? The truth is, nobody can predict with absolute certainty, but by watching key indicators like interest rates, unemployment, and housing supply, you'll be better prepared for whatever happens next.